Welcome back to Through the Pines, a financial planning podcast with the down-to-earth vibe even Sasquatch would subscribe to Spotify for. This is Through the Pines. All right, episode 10, what 75 years of the financial industry has taught us. I am not included. That would be our guests. So combined, they have 75 years experience in the financial industry. Please welcome Rex Baxter, Brandyn Smith, and Dan Nelsen. Thanks so much for joining us today. We're going to cover some of the mistakes, myths, technology, advice that you guys have learned by, working every day in the financial industry for 75 years. Rex, how long have you been in the industry yourself?
Just under 25 years. So I started in the kind of late 90s, 97.
97. Let's just you alone. What's one thing that you've noticed or a trend or something that stands out to you the most over the years?
That man, there's a lot of them to make
one,
Brandyn. That the market has an amazing ability to make a fool out of the maximum amount of people at any given point in time.
Wait, so all the people on TV are full of crap? All the pundits, all the financial gurus, they can all be...
Full of crap is a big word, but but I would say nobody can predict the future.
Yeah, for sure. For sure. All right, Dan, you've been in the industry now for how long?
40 years.
40 years. So a couple years longer than Rex. Yeah, what's one thing you've noticed? What's a big change that you've seen over the years?
Well, I've seen lots of change. I mean, when we started in the business in 1980, when I started, we basically had no computers. And so we had a little Quotron machine, and everybody knows about the ticker tape that they used to see years ago. But everything was done on paper. But the biggest mistake, the question you asked, the biggest mistake that I've seen over the years is emotion takes over at the worst time in the markets, and people make mistakes. In other words, they sell low and they buy high.
But Dan, they lost a lot of money, and so why do people do they even call their planner? Like, what happens where they just sort of like, I just suddenly sell?
This is the most important thing about the advice that we give as a full financial planner, as an advisor. We can help guide and calm the most nervous in the periods of time when they should be buying because we're near the bottom of the market, versus selling when they're scared and fear is taking over. So that's the biggest advantage that you have out there by working with a professional that can help you make those decisions at the right time.
Yeah,
I have countless hundreds of examples over the last few years of that.
Yeah. Very good. Brandyn, how long have you been in the industry, and what's one of the biggest mistakes you've seen, or one of the biggest things you've learned in your time in the financial industry?
Yeah. 11 years in the industry, and
he's a baby, Rex. He's a baby.
Baby, that's over a decade.
No, that's pretty good.
No, knowing what you know and knowing what is speculation, and really deciphering between those two. We work with clients, and sometimes people like to take bets, and that's all right, as long as you understand it's a bet and not a calculated risk, right? And that's one thing we try to help people do is help them understand what we can count on, and as far as long-term trends and what we can plan for, versus what is maybe just a hunch. And if you can really distinguish those two, it helps a lot.
Yeah. So, I mean, a lot has changed over 30, 40 years, but a lot has changed in the last 2 years, because we now have coin-based products in the industry. Dan, did you see any of this coming?
Something called Coinbase? No.
Yeah.
Never thought about that.
Yeah.
Different types of currency. We always had the gold standard. We always had the dollar. Currency was a commodity, just like pork bellies or corn or anything like that. We had commodities, but no, did
Yeah.
not predict Coinbase.
And then how many times are you talking with a client and they say, yeah, but I use this software, or my program tells me this. And I think, like, how often do you run into something like that?
Often. One of the things in the last podcast, I think I talked about the fact that 40 years ago, we had two services, which was information and execution. Those are both free. In fact, information is 24/7. You can watch a program like CNBC and get 4 different opinions in a half an hour.
Yeah.
4 different opinions in a half an hour.
Yeah.
Talk about confusing the American public. So it's a real important that you have guidance or direction, or have some help, a calm mind, a calm person, an advisor to check in with and say, what do you think about this? Or what do you think about this? And get a second or third opinion for sure.
Is there a piece of technology that you use now that helps you in your day-to-day work when working with clients? Besides a laptop and a phone? Yeah, the phone.
A phone.
Yeah.
Yeah. The technology today is so dramatically different and so up to date, and the information is instant around the world.
Mm-hmm.
It used to be that there was a hurricane even on the East Coast, like we had in New Orleans. You wouldn't know about it until the nightly news, okay? Or if it was in Europe or some other part of the world, it would be 2 or 3 days before you knew about it.
Isn't that wild?
Today, you know about it right now,
right,
instantly.
Right.
When it happens.
Yeah. Rex, technology's changed over the years. I mean, 75 years experience between the three of you in the industry. Are there apps that you suggest people use? Are there things that, you suggest that clients can go to now in 2021? Like what's some of the bigger changes that you've seen as far as technology goes?
Well, I mean, I think the most important app anybody can use is the Ameriprise app, Brandon.
Oh, really? The show is sponsored by Ameriprise. Really, it's not. But
it's not. But there's a shameless plug.
Yeah.
Right? So
they do have an app.
Work at Ameriprise, and we do have an app. I think there's a lot of amazing apps that are out there. Whether it's a news app, whether it's calculator apps, whether it's aggregating your accounts and investments so that you can see them all in one place at one time. And so I think there's a lot of amazing apps that are out there. And at some point we may want to do a podcast on financial apps. That might be interesting.
Yeah.
To do something like
that. I mean, the kids are using them, Rex, and they're using a lot of them. And one of my favorite ones I see getting used the most is the one that just takes your excess change on a purchase and throws it into an account. And it's a great way to invest a little bit at a time.
Yeah, I think it was it Ashton Kutcher that started that with
was that his?
And started.
Yeah, Acorn. Yeah,
I think so. I think he was one of the first investors in that, if I remember right. But I think it's a big deal because instead of throwing your coins, your extra change into a coffee pot, like our grandparents or something like that, now we're throwing them into fractional shares of stock or fractional shares of investments. And I think the one thing that's been interesting to me in regards to that is it's gotten the millennial generation to become really good savers. Contrary to popular belief, the millennials are phenomenal savers. Now, I'm not sure that they're great investors, and I'm not sure that they're great at taking advice and some other areas just yet. And we could debate that left and right, but everything that I look at and see is they're doing a great job of keeping the debt down and keeping the savings up, which is impressive.
Yeah, I think they have more access to information, which is good. There's more places to learn. So
absolutely.
Yeah.
Yep.
All right, Brandon, what technology have you seen in your 11 years of experience? It's crazy how fast things change because, I mean, even Facebook was just fairly new 11 years ago. So it's a lot has changed in the last 10 years.
Yeah. And with the planning software, I mean, it used to be back in the day, a financial plan was done kind of at a 10,000 foot level, right? You take the amount of assets, you take a distribution rate, and you kind of run some calculations, say, I think you can retire in about this. I can't tell you how many, engineer type minds I've met with who have built out Excel spreadsheets, right? And they have categorized every asset they own. They project it into the future. They're trying to run like the inflation and all those things, which is highly commendable.
I'm so jealous of those people. That's amazing.
yeah. But every time that I've met with someone like that, and we show them our software that not only takes and projects the asset, but projects it with inflation, with different rates of return in the market, with tax rates, with penalties, with Social Security, with Roth conversions, with all of the different aspects, every time without fail, they just kind of take the Excel spreadsheet and say, yeah, this is awesome for a million things, but not financial planning. Now, I'm not saying you couldn't build a financial plan off of an Excel spreadsheet, but to do it right would take probably thousands of hours, and the odds of you not messing
well,
up.
that's why I haven't learned, yet. I don't have mine ready for sure. Maybe it's because I don't have the assets. We won't go into that. I don't know, but yeah. That's interesting. So the software that you've seen developed in the industry is powerful.
Oh, so powerful and so cool too. Yeah. I mean, we can build a financial plan for a client and then virtually walk them all the way around their financial plan and see it from different angles, see it in different scenarios, see it doing different life paths, right? And really show them and help them feel so comfortable and confident in where they're at and the future. Whereas before it seemed to be more of just a vague calculation with a rough estimate of how much you can take out of your account.
Those calculators are all over the internet too, right? You can always just go into the internet and type in this stuff and it's totally going to work because I'm totally going to stick to the plan, and then you never do. But does the software also include debt and debt payoff type information?
Yeah, okay. It's cool. I mean, we will show every dollar that you'll receive and every dollar that you're going to spend between now and your age 100 and project that out. And it's really fun, especially for the numbers oriented people, but even for people who aren't numbers oriented, to be able to look at that and see, what do my retirement accounts look like when I'm 70, 75, 80 years old, right? And how does it change if I take Social Security at 62 versus 70, and showing them all those things is really neat. The software on like the free softwares out there for financial planning are great. We use them with our 401k plans to help people kind of get that general idea. But then when it comes down to determining, what age do I file for Social Security? Do I need to be, converting Roths over? Do I need, what distribution rate will I be taking? That gets typically far more complex than most of those calculators can handle.
Yeah. Those are things we don't think about necessarily. So this is Through the Pines, and we are listening to 75 years of experience in the financial industry, featuring Rex Baxter, Dan Nelsen, and Brandyn Smith. Rex, what is the one piece of advice that you tend to give the most when you talk to clients?
I think the most important is start early, right? And so that certainly helps as far as starting early to save and invest and getting their kids to start early. But I think the most important advice is be open to receiving advice. Be open to listening to the professionals that are around you and trying to help you and guide you towards your goals. And so I think that's the most important piece.
Well, I wouldn't have thought about that. Do you run into stubborn people? Do people think they know better than you? You only have 20, 30 years in the industry.
But they have the internet. And so,
True. I mean, true. And the internet knows all. Yeah.
And a barber. And a barber and an uncle.
Yeah. And my brother and somebody so-and-so says, I didn't think about that. So is it hard to get people to trust you then with advice?
I think it depends on the personality, right? We have some that are very open and very trusting because a lot of our clients come from referrals, right? And so, they're listening to, their parents or they're listening to their kids. and saying, who should I talk to? And then they come to us. And so you get that level of assumed trust or borrowed trust, that so-and-so referred me, I trust them, therefore I trust you.
Mm-hmm.
And so with a lot of our clients, that's not too big of an issue. But then you get some that have been burned in life, whether it be in the financial markets, or they've been, subject to a fraud, or even in their personal life, in their personal relationships, to where somebody has broken that trust. And oh my goodness, that's hard to get back.
You were working with my daughter, and there was some trust. Like, she's like, what are you going to do with my money? And right. it's her first job. It's her first, we're not talking millions of dollars here, right? Like, but to her it was millions of dollars, and so you had to build trust.
Yeah, and I think you find that a lot, because I think the baby boomer generation is kind of a do-it-yourself generation. Mm. And so even though the millennials are very good savers, they've kind of borrowed that mistrust of people giving them advice from their parents in the baby boomer generation. And so it's been interesting to kind of see that dynamic kind of pass from one generation to the next a little bit.
Yeah.
So it is interesting, but I think as long as you're compensating an advisor in a way that's in your best interest, then you should build a lot of trust. And so, our average client's age, I think Dan's, mine, Brandon's, our clients stay with us for a long, long time. We have just an enormous retention rate, because they do trust us, and because we do give good advice, and we build very strong relationships with those clients over the years.
Yeah. And if you're curious, that was a good plug, Rex, by the way, planwithbaxter.com for more information. Dan, you've been in the industry longer than these two young bucks over here. Is there something that has stayed with you throughout the years? Is there a piece of advice that you've given, like when you started, and you still give it today?
Yeah, there is. One of the things I think is important is not only start early, like Rex just said, but be consistent about it. Don't start and stop for 20 years and try and start over again. Be consistent about it, and over a period of years, continue to save money. I used to tell people all the time that if you make $100, and I tell my kids this, plan on the fact that you're really only going to keep about 50 cents. $50 out of the 100.
Yeah.
Okay. Because of taxes, 401k contributions, other donations, other things that you might be doing. So don't plan on living on that $100. Plan on living your life on that $50. So be consistent about saving. And
Dan, that is not fun.
Yeah.
That is not.
I got my son-in-laws. I got some very odd looks when I was sitting down and talking to them before they got married to my daughters. So whatever you think you're going to make, cut it in half.
Yeah.
And that's what you're really going to make.
Yeah.
And live your life that way.
Yeah.
And then you won't be living your life on credit cards and other high income, high debt.
Have you noticed that people are learning this now in more places? Because I never learned that. Like if someone doesn't go to a financial advisor, where do they learn this?
They should be learning it in school. They take finance classes. You talk about these types of things. There is the millennials. There is a lot of information out there on the internet talking about this type of thing. The thing I'm concerned about the millennials is that they are savers. They're saving money, and they're learning a lot, and they're investing, maybe not consistently investing, and it might be more speculating than investing, but there is a lot of speculation out there. And the other thing I get concerned about is that I think a lot of people confuse a raging bull market with brains. So if you're in a raging bull market, for 7 or 8 or 9 years, you can basically throw a dart and make money in the market. And some people think that I'm the smartest person in the world because I'm making a lot of money in the stock market. Yeah. Unfortunately, we have bear markets, we have down markets and corrections. And that's when we really earn our money as advisors, to try and keep it consistent with our clients and our prospects to make sure they stay involved, stay invested, and will ride it out for the long term as an investor, as opposed to a speculator.
Yeah. Brandyn, what's the best piece of advice you've been giving your clients as of late?
Kind of along the lines of Rex is I think your compensation and the incentives matter. If are you paying your advisor such that when your accounts increase that their compensation increases, or are you paying them all up front? Right. And then, whatever happens. And I think you'd be surprised how often I come across people how often people just have no idea how much they're paying their financial advisor. If you don't know how much you're paying your financial advisor, that's probably an issue, right? Yeah. You should know how they're getting compensated and for what they are getting compensated. When you line that up and structure it such that, I am incentivized to help your account grow, it just tends to have a better outcome. I like to compare it to, shopping for cars. If you go into a used car lot or any car lot for that matter, I mean, what are the odds that the car salesperson is going to come to you and say, hey, you know what? I know you're here, but you really ought to go to the lot next door. They've got some nicer cars that you're going to like, right? Like that's just not going to happen. However, if you had someone that was with you, right, a fiduciary that was paid to help you find a car rather than paid to just sell you certain cars, they would go with you and look at the mechanics of the car. And then if they were compensated, if that car did well for you long term, the odds of you getting sold a better car are dramatically higher. And unfortunately, the car industry doesn't really have that, or at least it's not very prominent. But in the financial world, that's the thing, right? You can choose how you want to pay your financial advisor. And if you choose someone that is a fiduciary, right, that gets compensated, and your interests are aligned and you're sitting at the same side of the table, you're far more likely to have a better outcome.
So Dan said, plan on living off of basically 50% of your income. And to me, that's suffering. And so what is the difference between suffering and sacrificing for the better good and to have some good financial success later?
So I threw this one out there. That was my comment. I've often come across people who are suffering, but not sacrificing. And there is a huge difference, right? There's really two big examples and probably hundreds, but two main ones come to mind. And one is, I mean, I've talked to people who have told me, I'm not going to get a mortgage. I'm going to buy my house cash, or, I'm not going to, get a basic, conventional loan. I'm going to come up with a full 20% down on the house. And I look at it, I'm like, well, that's nice, but how long is that going to take you, right? You're going to suffer and pay rent for years and years and years. Meanwhile, house prices appreciate, and you're going to find you're going to suffer and sacrifice, but you're not actually going to reap the benefits of it. And so that's like the housing one, and then also retirement planning. People like, I'm just going to work till 70, and that's great, right? If you want to work till 70, that's fine. But why, right? Like what you need to understand what you're giving up and what you're receiving in return. And that's where financial planning can help, right? Is we can help you truly understand, are you just suffering or are you sacrificing with purpose, understanding what you're giving up today in order to receive something greater in the future?
Yeah. Very interesting. Rex, why do people, when second they get a raise in income, just like raise their level of spending? I mean, we know the answer.
Who doesn't want to do that?
Well, I know. It's like, hell yeah, new car, here we come. Just like
new
Brandyn
car,
said,
I'm going to Vegas.
Sacrifice no more. Yeah, yeah. Like it never goes into savings. Like, why are we like that?
So not only does it not go into savings, right? But people spend it before they get the raise. Right?
Oh, yeah.
Even my son, right? He's coming to me here today and he's like, hey, Dad, I'm going to get a raise in November. and so next thing I know,
spending
he
now
comes home with a new guitar. He's got a brand new guitar already, and I'm like, no, wait, you're not getting your raise for 3 months. So
Rex, I love that you can't even train your own kids. This is fantastic. Yeah.
I am absolutely the shoemaker that can't do his own, all those kinds of examples.
No, your daughter's done really well. But yeah.
It helps. I have 7 kids, and so I've got probably a kid example for about every situation, right? And so we can just share kid examples. But I think the reality is that people want the immediate satisfaction of kind of the now movement and the now generation, right? I don't want to wait for that gratification for when I'm 60 or 65. It's too far off. What if I die tomorrow? What if, and so we always hear life is too short. I need to live today. And the reality is that you need to live balance, right? I mean, if you live everything for today, what happens if you do live until tomorrow? Mm-hmm. And then you don't have any of the assets. But
Rex, you
that's
remember
something that we see all the time
when we were young and when we were skinny
last week.
Yep. And
2 weeks.
Yep. Yeah. And you had hair. So there's that. Yeah.
Yeah.
Remember that? And we both had Jeeps. Yeah. And I had a Jeep, a bullet bike, and a sports car. I think I was like 21. Do you remember that?
I remember that.
Yeah.
I do remember that. You had the 3 on the tree Jeep.
3 on the tree Jeep. Man, I thought that was living, but I didn't have a dime in savings at all. But I put money in the bank.
When you had all 3 of those, right? And I know you'll get on with your example, but you had all 3 of those. And it seemed like we were going to California for a trip with the friends.
Yeah.
And you're like, I can't go.
I don't have any money. I got no money.
Broke.
Yeah, I'm broke. Balance. That's what you're getting at is balance. Right. Yeah.
Yeah, absolutely.
Okay. Well, I've sort of learned it over the years, but I think I still kind of suck at it. Hey, Dan, what's your best advice when it comes to building an emergency fund? How much should people have, and how do they save for it? What have you learned over the years?
Back to the living on 50 cents on the dollar.
Yeah.
And 10% of that should be a savings for an emergency fund. So that's 30% goes to taxes, 10% goes to maybe a charitable organization, and the other 10% should be paying yourself for savings, emergency savings. That's the key.
But what if people have so much spending that it's hard for them to save that much? Now they got to pay down some debt. Yeah, that
is typical of most. It's not easy, and so you start with 5% or 3% or 2%, and you work on that to get that a little bit better.
Rex has something. Rex's hand is up here. Yeah.
So Dan, with 40 years of experience, let me put you on the spot. Saving for an emergency fund out of that 50 cents on the dollar, or 401k match with that 50 cents on the dollar. Where do you lie, out of curiosity, between those two?
5% for savings and 5% enough in the 401k to get the full match. So whatever your match is from your company, get the full max, and then the rest goes into a savings account.
Yeah, I'd completely agree with that.
Max the match. Is that right?
Yep.
Hashtag max the match. Yeah. Okay. And then Dan, what's your advice when you run into people and they might even have high earnings, but they also have high credit card debt? Everyone knows, famous Dave Ramsey, and see what's your advice to helping people reduce their credit card debt?
That's the key to, like Brandyn has been talking about, financial advisors. I need to do financial plans with the clients. Mm-hmm. If you are doing a full financial plan with your client, that comes out. And it becomes very obvious in the discussion that is the worst kind of debt. And that the first thing we need to do is take care of this debt over a little bit over time. You can't do it. It's got to be a balance, but you can't do it all at once. But you need to take care of that debt and get rid of those credit cards and start cutting them up.
Yeah.
A person should have a couple of credit cards at the most, and they should be living their life based on what they're earning.
And then those who Yeah, but I just need the airline miles.
I know. That's my two cards. I have one for airline and one for hotels. So there you go.
Need the airline miles. Brandyn, have you seen that people are closer to retirement than they think they are sometimes?
Yeah, almost always.
Really?
You know, and yeah, and it's. I think that's one of the reasons I love my job is when we sit down and do a financial plan. I mean, 9 times out of 10, if not more, people walk out and they're just like, wow. And it's not always that, yes, we're ready to retire, but typically, right, people who are like, oh, I haven't saved, I'm a little bit late to the game. Sure, they're late to the game, but when you really dig into a plan, I mean, for easy numbers, let's say someone's making $100,000 a year, right? They look at that, they might have, $200,000-$300,000 in savings, and they're looking at like, cool, simple math says that lasts me 2 to 3 years, right?
Yeah.
But the reality is they're not spending all of it. In fact, while you're working, your taxes are typically higher. A lot of times there's a mortgage that will get paid off by retirement or maybe a little bit into retirement and then go away. Hopefully they're saving a little bit into 401k that won't be happening in retirement. And so when you back out the taxes, the savings, the mortgage, you realize that you're actually living on a lot less than your take-home income. Then you pair that with in retirement, we got Social Security that kicks in. If a spouse, even if they're married, right, and one's been working, one's been staying home with the kids, that spouse can take half of the other benefit while they're living, right? And so you get 1-2 Social Security benefits kicking in addition to reduced taxes, reduced savings, loss of a mortgage. And the picture actually starts to typically come together a lot better than people really initially anticipate.
What's the average amount that people are hoping to retire with right now? Is it, because it used to be, if I was a millionaire, I'm going to be loaded. Is it closer to 2 million now? What's like, where are people sitting these days?
It is so relative.
This is
so relative.
Rex's depends.
Income.
Yeah.
No, I know you hate the it depends answer, but it is. Do you have pension income? How much Social Security income are we receiving? Literally, it's in Utah. You see a lot of people, with a few $100,000 clear up to $1.5, $2 million, right? And so that's kind of a range. But you can typically retire in Utah pretty well with few $100,000, and it just depends, right?
Yeah.
It really, I shouldn't even throw numbers out there because it really depends on what you're used to living on, right? If you're used to living on an income of $50,000 a year, your savings is a lot less than if you're used to living on $100,000 or $200,000 a year.
And then this is kind of an odd question. I just thought of it, but because when you're retired, do you need to be adding to savings? Because you know what I mean? You're spending it instead, right?
Yeah. And that's a fantastic question, and one we try and help our clients understand is I'll project that, right? I told you we project each year cash flow, and I'll fast forward and say, now that we're in retirement, this is what income looks like. We're pulling this much from Social Security. We're pulling this much out of the IRAs and 401ks. And then we'll set that up for clients as they get into retirement, right? Mm-hmm. Where they'll have $2,000 a month automatically just hitting their bank, right? And in addition to that, they've got money from Social Security hitting their bank. And we're trying to hit that target, right, to help them essentially replace that same check they're used to getting, every 2 weeks. It's just replaced with Social Security and retirement account distributions, sometimes pension income.
Yeah. Hey, Rex, besides not starting early, where do people go wrong with their finances?
I think that I think two things. I think one is the I want some of that mentality. And so something that has doubled, right? All of a sudden everybody wants it, right? Because it's done so well. So, they tend to do the exact opposite.
Yeah, Bitcoin
of what they should
or something,
right?
Like, whatever the new trend
something,
is. Yeah.
Right? Whatever the new fad is, and whatever's gone up so drastically that's when it's interesting. So there's study after study that looks at money flows on different mutual funds. I think Fidelity has studies, Vanguard has studies, things like that. And traditionally, the mutual funds that get the most money flowing into them happens to be whatever fund did the best the previous year. Right. And so people are notoriously buying high on those funds as opposed to a good diversified portfolio and then rebalancing. The beautiful, thing about rebalancing is it forces you to sell high, to sell what's done well, and it forces you to buy the underperforming areas of the market. And so I think, when I think about what do people do wrong and what, if they're not being helped by an advisor, I think it's the following the herd mentality of everybody wants ABC stock or wants some digital currency or something because it's gone up, and yet they don't understand why, they don't understand behind it. And so they're just following the crowd, and notoriously that puts them in a bad spot. So,
yeah, because if you're talking with your buddy at your job or whatever, you do, and they say, yeah, but do you own Tesla? And you say no, then you look bad. Yeah.
Well, and it's funny because people do that all the time, and their ego, what was it? Was it Top Gun to where his ego's writing checks, his body can't cash, or whatever that was, right?
Yeah.
So I mean, same thing with investing, right? Yeah. Is people's ego like, oh my gosh, my neighbor has this digital currency and it sounds like it's so good, and yet everybody brags about their winners and is silent and crickets on their losers typically.
Well, yeah, I do like it when people brag about how much they lost. That's pretty fantastic. Yeah.
Right.
Yeah. Which is fun because then you're like, aha. And we don't always win. Yeah. Yeah.
But how often do they tell you?
Not very often. Yeah, for sure. Hey, Brandyn, what, should we ask some more numbers? We got numbers, right? For this podcast? Yeah. Let's go over some numbers. We like to call this segment "SMORE Numbers" with Brandyn Smith.
So a little bit away from the financial topic, but this one is interesting. IHS Markit did a study, and they said the average car on the road in the U.S. at the end of 2020 was 12.8 years old, up from 10.2 years old at the end of 2005. So, and I don't know, we always like to interpret what that means. It means, I guess, I don't know, that cars are lasting longer or built better, so much as maybe people were worried about not being able to buy new cars or worried about pandemic stuff. And they, instead of buying a new car, they held on to their old one, or they couldn't buy cars because, I mean, car lots have about a fifth of the cars on the lot that they used to have, just from production issues. And so people are fixing their cars. I guess that's good news for car mechanics, bad news for car salesmen.
Bad news for car salesmen because they don't have the inventory to sell right now, which, and even used cars is tough. But I do think technology has something to do with it as well. I mean, I have a Land Rover and it's 11 years old and it still has heated seats, a backup mirror and camera. You know what I mean? It has like pretty much a lot of the same things that brand new cars have. So the new things that cars have now where I'm getting a little jealous are, I don't know if you have these, cooled seats. Cooled seats are the next level right there. And then like the backup cameras are just a lot nicer and bigger and brighter. And then of course, electric, so as we move into electric vehicles, I'm curious to know how long gas vehicles stay on the road over the next 10 years.
Yeah, it probably has a lot to do with efficiencies, how efficient can they become?
Yeah, for sure. Hey, Dan, let's talk about retirement real quick. You've been in the industry for some time. Again, the 75 years of financial industry experience here with Rex, Brandyn, and Dan. What's the plan for Social Security? When do you leave it versus an IRA or 401k? Do you ever not take Social Security? Like, how does that work?
You take it.
Always take it. Okay.
Eventually. You obviously take it because you've been contributing to it in your whole life. And in one other segment, I think podcast we talked about, is it going to be there? I have some thoughts about that. And there is no political party on either side of the aisle who's going to be in charge when they cut Social Security. Believe me, nobody's going to do that.
Yeah.
So I feel comfortable. I mean, I'm 65, but I feel comfortable that Social Security will always be there in some form. Now, there's some issues with it as far as funding it, but they will figure that out if it's the last thing that they can accomplish in Washington.
Yeah.
So as far as retirement goes, you've got to determine with a financial advisor, what's the best time? Is it 62? Is it 67 and 4 months like my full retirement? Or is it 70? When should you take that? And it is based on your income. It's based on other sources of income. It's based on your lifestyle. And it's also based on life expectancy. Mm-hmm. Oftentimes you'll look at your parents and grandparents and think to yourself, how long did they live? Your grandparents probably didn't live as long as your parents, and you're probably going to live longer than your parents because of medical technology and everything that's happened in the medical industry. But you should look and determine, I'm going to live till I'm 84 on average, or 86 on average. When should I start taking it versus how much other income I have coming from others? So the key is sitting down with a financial advisor and doing that calculation.
And then
one more shameless plug to the financial planning. That is where it's so cool. We can build, like I said, build that financial plan, walk all the way around it, see it as it is. And then we can just make tweaks, right? Change just Social Security and say, what does it look like if we take it at age 67 versus waiting till 70? And just look at the projections of your assets. What does that do to your 401k? What does that do to your cash flow? What does that do to all these things? And really just side by side, look at your comparison. Side by side, look at when you break even, right? Oftentimes people try and run a break even just like a straight line break even. If I, just take that money out of Social Security and put it in savings. But really you need to be taking into account penalties, taxes, income rates, all those different things. And a financial plan can do that and set those side by side and really help you understand when is it most advantageous to take Social Security.
Again, we're talking with Rex Baxter, Brandyn Smith, and Dan Nelsen. Planwithbaxter.com. For more information, go to planwithbaxter.com. We'll end with this question here. Brandyn, what, and I want to get an answer from all three of you. What's the biggest misconception you've seen around what people believe in and think when meeting with your clients about finances and the financial industry?
That's a good one. Misconception, I think, is that we can predict the future in the markets. And you just can't, right? Anyone who thinks they know what's going to happen in the market, it just is. Even if we had perfect data, all the data in the world, perfect analytics, we still couldn't predict future variables. And so that's where it really comes down to when we build your investment portfolio, we build it such that, if the markets go down like they did in 2008, we're still going to have enough safe money set aside that we can pull from and get us through that downturn and let the markets come back and let the rest of your assets come back. And so I think the answer always comes back to, in my opinion, because we often like to kind of hedge our portfolios or get a little bit heavy in one or the other. But at the end of the day, it's so important to make sure that we always keep a portfolio built the way it's supposed to be built so that whether the markets go up or whether they go down, we're still going to have something to fall on and get through it.
Yeah. Dan, what are your thoughts? What's the biggest misconception your clients have come to you with?
I think the biggest misconception there is out there is they think that it costs way too much to talk to a financial professional. Yeah. In reality, it doesn't cost anything. Anyone can call any one of the three of us and say, I'd like to spend an hour with you and get some advice. It would not cost them anything.
Wow.
That first time.
That's a huge deal. Yeah.
It is. That's the biggest misconception.
Yeah, because you guys have been 75 years between the three of you, and you guys talk to each other, so you know each other. And if someone has a question, you guys all, can come up with the answer. So it's free to reach out. And then the way you guys make money, do you want to explain how you make money real quick, Dan?
Well, sure. If we engage the client in a financial plan or in a relationship where it's a long-term relationship, we work out the fee or the structure of the fee going forward. But it always makes sense on a net basis. How much am I making on my investments versus how much is it costing me? The value that we should be able to add way outweighs the cost of working with a financial professional.
All right, Rex, final thoughts, biggest misconception and anything else I may have missed on the three of you. 75 years of experience. That means you're old, Rex.
75 years of experience. That's a pretty big number.
Yeah.
When we were putting this podcast together, I think both of their points should be very well regarded and taken, as far as can't predict the future at all as far as that goes. Yeah. And it's not too expensive to talk to us. As a matter of fact, it's probably the opposite. It's probably too expensive to not talk to a professional. I think one of the other misconceptions out there is that they're better off doing it on their own. Is that they sometimes will run into people that think 75 years of experience and that they can learn it in 10 minutes on the internet. And I'll tell you what, with financial planning or investing, there's as much art to it as there is science to it. And the science is very studyable. It's very learnable. Art comes with experience. Art comes with understanding people's personalities. It comes with understanding how they behave during market upturns and downturns. It comes with all that experience. We have the innate ability to pull on that to help guide you towards your goals and help guide you to be efficient in the way that you're managing your money. And so, I wouldn't undervalue that experience in comparing going it alone versus using an advisor.
Excellent stuff. That is Rex, Dan, and Brandyn here on the Through the Pines podcast. For more information, please visit planwithbaxter.com. This has been Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams.